Hey everybody, good to be here. My name is Brent Moores. I'm sitting in for Connie Hills, who's out today, talking about short verticals. So I want to talk about specifically volatility in this market. This market's a little bit crazy. Another down day in the market, and you know what? We're happy anyway. You can be happy even if the market's selling off. That's what we're going to talk about today. There's some good things and bad things. Volatility can actually work to our advantage in this case with short verticals. So we're going to talk about that. And I'm joined alongside Mr. Cameron May. Always appreciate Cam. He's not just a good trader and good instructor, he's a good guy too. So we're glad to have him. And you can follow Cam or myself on X at BrentMooreCS, at Cameron May CS. And welcome to you, whether you're watching live or on a recording. Remember, we will deal with options today. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only and should not be considered an individual recommendation or endorsement of any particular security strategy or chart type. We will look at those today. We will look at charts, we'll look at securities, we'll look at strategies, but they're not recommendations. Schwab does not recommend the use of technical analysis as the sole means of investment research. I'm probably not going to factor in commissions today when we're looking at our examples, but realize commissions are a real thing. Commissions and fees is something you should consider. The paper money application is for educational purposes only. All investing involves risk, including risk of loss. And short options, which we will be dealing with today, can be assigned at any time up to expiration, regardless of the in-the-money amount. And stop loss orders will not guarantee an execution at or near the activation price. Past performance of any security or strategy does not guarantee future results or success. Let's head on over to the Thinkorswim platform. Here's the SPX, the S&P 500. Oh, another big candle, down almost 1.5%. I haven't looked at the NASDAQ, but I suspect it's probably down more because generally when the market goes down, it's down a little bit more than the S&P 500. When the market goes down, the NASDAQ tends to go down more than the S&P 500. And when the market goes up, when it has a real bullish day, NASDAQ tends to outperform. That's not a universal rule, but it's just kind of a generalization. But here's what I want you to point out. Like right now, this is what we're all experiencing this right now. But I want to show you something on like the VIX. So implied volatility here, folks. Notice what's happened with the VIX. The market has been going down, down, down. What's the VIX done? The VIX actually went up, 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 which you'd kind of expect. Kind of tailed off. In fact, a little while ago, the VIX was actually down for the day, even though the market was down. Now the market kind of accelerated its move down, and so it's up a little bit today. But it appears that, you know, given what we've seen in the market, the VIX implied volatilities levels may be mellowing. The market may be kind of acclimating to what we've seen. You know, I don't know if that's fatigue or what, and maybe that'll turn into a turnaround in the market. But even if it doesn't, it appears that some of these implied volatility levels may be dropping, and that can help us. Okay, and why? Because the VIX, or implied volatilities on individual stocks, implied volatilities on the options on individual stocks, affect your option pricing. And in general, what happens is when you have higher implied volatilities that are dropping, it tends to benefit short options. Short calls, short puts, it tends to benefit you. And because implied volatilities are a measure of option prices. And if the price, everything else being equal, of that option drops, and it's a short option, which you're having to buy back after you've sold it initially, that's a good thing to you. Now, of course, some of you may be saying, hey, in the case of a short call or something like this, a short call vertical, Brent, I have a short call and a long call. So let's just kind of think about this for a sec. I've got on a short call vertical, we've got a short call, we've got a long call, and we're buying one contract, we're selling another contract. One of them, the long call, is what we call a positive vega trade. That means implied volatility dropping would hurt us on that trade. And the short call, it's a negative vega trade. Implied volatility would tend to help us. So is it a wash? The answer is no, it's not a wash, because if you're doing these out of the money, the short call is closer to being at the money. The vega is going to have the bigger effect on the short call. So this is kind of the dominating contract in that case. So net, out of the money verticals, short verticals, are negative vega trades. The same thing is true with short put verticals. A short put vertical is you're selling a put, you're buying a put. LP stands for long put. You got a negative vega short put, you've got a positive vega long put. Which is the one that's going to dominate it if it's out of the money? The short put. Okay, so in that case, it is a net negative vega trade. So a drop in implied volatility can possibly benefit us, regardless of whether we're going bullish or bearish. So when we're doing these trades, what we want to do is you need to come up with your forecast for your stock or your market and come up with a polarity, so to speak, with the trade, bullish or bearish. But we're going to do our best to hopefully the implied volatility environment is going to benefit us on this. Now, if you feel that, hey, look, this is what we're doing and there's no end in sight at this, we may slant a little more bearish. We may look for more bearish trades. If we feel, hey, maybe we're going to turn around here, then maybe you look for more bullish trades. Of course, the individual stocks that you look at can be bullish or bearish, but well, let's take a look here, okay? So I'm going to go and I'm going to look at ExxonMobil, just as an example. And here we go. So what I'm going to say here on this one is, I'm going to say, here's ExxonMobil, and we have what appears to me, at least, to be a pretty good resistance level there. Would you agree with that? Maybe, from a technical standpoint, it seems like that seems to be a level that's lower, and that's a potential resistance level. And I'm going to assume that the stock is going to stay below this level. Okay. And so there we go. That's that. Now, this really, I could do the same thing down here and say, here's a support level, maybe. And you could do it from a bullish standpoint here. But I'm going to take more of the bearish approach, and I'm going to look to do a short call bearish trade here on ExxonMobil. Just remember, whenever you're doing options, make sure that the liquidity is there on your trade. And Paul said something in the chat that's an interesting chat. It's good. I like to share sometimes what your chats are for those of you who are watching on a recording. Paul said, another alternative is you can just sit back. Absolutely, you certainly can. You don't have to guess what the market's doing right now. You can say, look, I'm going to wait until I get a more clear entry signal, and then I'm going to, deploy capital at that point. There's no problem with that at all here. But if you want to go more bearish, we could do a short call vertical. So that's what I'm going to do now. Now, Ricebird said, well, look, I'm considering maybe doing an iron condor on this. You could short call vertical, short put vertical at the same time. Would that be that iron condor? But let's take a look here. Now, of course, what I said was, if we look at the implied volatility is kind of high on this. My assumption is this implied volatility is, it certainly can go higher. There's no doubt on that. My assumption is that it's kind of at a higher range, and it may indeed drop from here. So let's go here. Well, I have a resistance around that 112 level. I'm going to go to trade. Let's go out. We'll go out 35 days. Go out about a month or so on this. And see what we got. I can go to the one, let's see, doing a short call vertical. I already forgot. What was our resistance was about 112 on that. Okay. So let's do this. I can go and let me see if I can get some more strikes going here instead of strikes every $5. Here's a 113. that works. Let me just get a couple more strikes here. Let's do the 113. And Greg said, what are we going to do if it breaks above that? We'll address that here in just a sec. Okay. So I'm going to go to the 113 strike that's above our resistance. I'm going to click on my bid price. I'm going to go to my 114 strike. I'm going to hold down Control, click, and there's our spread. But before we do that, let me just point out something here. The Vega isn't huge on this. The Vega difference isn't that huge on this. Now this rounds to 2 decimal points, so you don't know exactly the amount, but really the Vega isn't a huge difference between those. And so really the net difference is 0.01. So I don't want to overblow the importance of Vega here, of implied volatility on the trade, but we're doing this as a bearish trade anyway here. Okay, now, if I want more Vega difference, I could go to maybe a 115. That would give me probably a little bit more of a Vega difference than the 113, 114. I could do a 113, 115. That's no problem. But let's look at this for a sec. One reason you may do short verticals or verticals as opposed to just doing a short call or something, is your max loss is limited, right? It's $64 for the one contract, okay? $64 for the one contract. So you don't have to put in an exit on that, a stop loss or anything on that. We're trying to limit our loss by doing the spread. However, we may say, look, if my stock if we break above here, I'm going to get out. If we break above 113, we'll say, I'm going to get out of that trade. So we can put that order in to exit there. Now, you may say, well, 113, are we going to be at a max loss? Probably not. Probably, assuming it occurs before like the last day, if we're looking to get out a week ahead of time or something, we probably won't be anywhere near a max loss if we go to that 113 level. I can't make any guarantees on that. So what we can do is we can put in an exit order to get out if it breaks above that 113 level. So there you go. So Sheila says, what's a good Vega number to stay within? What I would say is don't worry about the individual number, but in this case, keep in mind what your Vega is and what your anticipation is in comparison with where you think implied volatility is going to drop. In general, this type of trade is going to benefit from a drop in implied volatility. So we want anything, I don't care what the number is, but we want anything with a positive or neutral volatility here. Anything with a negative implied volatility, a negative Vega, is going to benefit us. So in our case, we're only at 0.01. It's not going to have much of an effect, but it may help us out a little bit. But if we're doing a trade like, say, a long call, just a long call, or in this case, bearish trade, a long put, we can do that, but just realize implied volatility is going to work against us. Now, if I want to put in an order to get out of this guy, what I'm going to do is I'm just going to change this to first triggers. So you can either do first triggers sequential or first triggers all. It doesn't matter if you're just doing 2 orders. And then what I'm going to do is I'm going to right click on it. Okay, and I'm going to create an opposite order. So this is my order to get in. This is my order to get out. I'm going to make this just a market. Good till canceled. I'm going to go to the gear, click on that gear, and we're going to say, well, I want to get out if ExxonMobil marks greater than or equal to 113 was our exit. Okay. So easy enough there. Now that's an exit based on the stock price, on the underlying stock price. All right. Now, if I wanted to, I could say, hey, look, I want to get out based on not the underlying stock price. I want to get out based on that option price. Fair? You could do that too. In that case, I would just say, I'm going to do, instead of market order, we'll do a stop. Could I also do an order to get out at an 80% gain? Yes, let's do that. We'll do that on our next example. Let's send this one though, and I'll show you on the next example that. How about, okay? So I'm going to do, and there we go, it filled, okay? So let's do another one here. We just did ExxonMobil. You could look at other trades that maybe you deem to be bearish. Here we have a pretty strong trend down. We have a potential resistance level. Is that a possibility? Yeah, I already have a trade in my account on this paper money account on Oracle, so I'm going to skip that right now. But just to kind of give you an example of something where the trend is going down, a little bit more bearish trend than what we were just looking at. Let's look at Disney. Disney. Here's Disney going down. Look at our implied volatility here. Our implied volatility is here. So it's more towards the higher end of things. We'll see. Now, if implied volatility continues to go up, keeps going up, it's not going to help us in this case. But we'll have to see. So let's do this. Let's look at Disney. I'm going to assume that this kind of gappy thing right here, you see that? I'm going to assume that this is kind of going to be a resistance level. I'll go bearish on this. Maybe we'll do a bullish trade example too today. That's right around 100. 100 is a nice even number there. And let's talk about getting in and then getting out based on option prices, not underlying stock prices too. So Disney, 100 is our resistance. I'm going to go to trade. Let's not go out 43 days. We'll go out we'll go out to the monthly contracts. Okay. I'm going to say 100, and I'm going to go right here, and I'm going to sell the 100. I'm going to buy the 105. Hold down my control key. Let's look at our Vega numbers here on this. 0.12 and 0.09, so a little bigger on this one, okay? So a drop in implied volatility would be more impactful on Disney than it would on, what did we just do, ExxonMobil, okay? But here's the trade. So I just have one contract in here, and of course I can alter this and do more than one contract. Right now the max loss is showing is 356. But we'll put in a stop order on here. Okay, we're going to put a stop order on here. So what I'm going to do is I'm going to make it a first triggers OCO order. Okay, I'm going to right click on this. I'm going to create an opposite order. I'm going to right click on this, do the same thing. So I have an entry order right here. I have two exit orders. The entry order is to sell a $100 call, buy a 105 call, and our two exit orders both have are buying back that 100 call that we're initially selling and selling the 105 call, the one that we initially bought. This is called an OCO order for those of you who aren't familiar, meaning one cancels the other. The first triggers part of this means these orders to get out are only going to be valid if the initial order fills. Once that fills, we'll call this order A and we'll call this order B. Once this order fills, this initial order fills, then whichever one fills first, A or B, is going to cancel the other. Okay? That's what an OCO order does. Okay, so let's do this. Now, what are we going to do? Let me get on my little drawing tool. We're going to say, look, I want to get out at a stop order on this, on a stop on this guy. Okay, and I'm also going to get out at a limit. And John said the Dow is now down 486. It is going up again. It's a roller coaster, isn't it, folks? Yeah, that Dow will kind of drive you crazy right now watching the markets right now. Now, in terms of exit orders, there was a question from, I forgot who said, can we do, Marcia said, 80%, can we get out an 80% gain? Yeah, a limit order to exit is going to be if things are going well. Can I get out at an 80% gain? And the answer is yeah, I can get out if I get an 80% gain on this. What's an 80% gain? Well, 80%, so if I could just do, well, look, if I'm getting it at 145 and I've made 80%, that means I could just multiply this by 0.2 and gives me 0.29. That means I could get out at 0.29, okay, 0.29, okay? That's a limit order, good till canceled, okay? Or if you want, what you could do is you could change this, make it trigger, and you can go percentage and do it as minus 80% there, okay? So you can do it as a percentage, or you can just do straight up the 29 there, all right? There we go. So what about a stop order? Yeah, I can do a stop order as well on this. Now, keep in mind though, short options can be assigned early. So if things are going against us, let's say this, I'm going to just put stop, good till cancel. Let's say this stock goes up. Right now we're at 97 bucks-ish, and we're selling the 100, we're selling that, we're buying the 105. Let's say that stock goes up. Now, keep in mind, it can be assigned even if it's out of the money, theoretically. It's probably unlikely, but it could be. But the odds are more likely if the stock goes in the money that we could end up being assigned this short call at the $100 level. And so, but if the stock does go up, then the price here is going to go up as well. So that 147 is going to go up. And you can say, well, you got to give it a little wiggle room. You can say, well, I don't want to lose anything. I want to get out if it gets to 150. Well, just minute by minute fluctuations, it's going to go up and down a little bit. So you got to be kind of realistic on this about how tight you're going to put that. But let's look at our max. What's our max loss on this theoretical? Max loss is 350. Okay. Well, let me go back here. What would a 353 max loss represent, and how could we get to that 353 max loss? If we're starting out with a 147 trade, there's a $5 gap between my strikes, 150, 105, and 100. The theoretical max is going to be to buy it back for $5. Okay, that's the theoretical max loss. But is that a $5 loss on it? No, that's not a $5 loss on it because we're selling it up front for 147. The difference is what we sell it for to what we buy it back for would be 353. That's where when I saw that 353 theoretical max loss, that's where that's coming from. It's coming from the spread width, the 105 minus 100, minus that initial credit, which is 147. It's moved a little bit on us here, but that's where that number comes from. So if you want to say, well, I'm willing to lose half of that, I could say, well, 353 divided by 2 is 176. And if I add that to my initial price is 1.47, that gives me 323 as an exit, okay? So I can go out and let me get rid of this, and we can say that. So we're going to make this at 323, okay, 3.23. Stop, good till canceled. There we go. Does that look right here? Ted, I just hadn't changed the number yet, okay? You would not use a 145 stop loss on that. That's why we have this stop loss here, okay? So So there we go. And again, if you want to do it as a percentage thing, you could do the same thing I did over here and showed you can change that link to the trigger and do it that way. Okay? Trigger plus 50% if you wanted. That's going to be that trade. Confirm and send. And we're going to throw that in the short verticals bucket. Let me just do, let's just look here real quick. Has that price changed? Yeah, this is probably worth just a moment here of discussion. Right now, the price is showing as 144. That's the mid price. It is probably unlikely this would fill, especially in real life. This is paper money, but it still probably wouldn't even fill in paper money right at that mid price. Okay, well, probably have to go a little bit less than that. Instead of that 144, maybe you go down to 140. Okay, that's not going to materially change the numbers here. So what I'm going to do is I'm just going to make this 140. See if we can get filled there. Confirm and send, and throw that in our short verticals. Send. Voila. Okay. There we go. That's another bearish trade. Should we do you can do bullish trades here too, folks. We did a couple examples on bearish. There are some stocks that are kind of bucking the trend here right now. Let me just give you an example here on this. Here's a bearish trade. Just give me a more bullish trend on this. And just, I appreciate the chat, everybody. Just a reminder to everybody here, I'm giving you examples, okay? They're not recommendations. And look, if you're bearish on AbbVie, then you wouldn't do a bullish trade there, okay? And vice versa, when we did the bearish ExxonMobil and bearish Disney trade, if you're bullish on those, you certainly would not do these bearish trade examples that I just did. All right. Okay. Now, so let me address a question though. Okay. And the question from Ellie was good question, great question. How can you identify what price we will be filled? Okay. Let me spend a little bit more time on that. In the example we just did, I'm trying to remember the numbers. This is, it was, I think I can't remember. I'm just going to make up new numbers here. 145 credit. This is a credit spread. And that was showing as the mid price. Okay. So that was shown as the mid price. Ideally, we were able to sell it up front for as much as we can. Okay. And I'm just going to make we'll say the ask price is not the ask price, the natural price. Okay. The natural price is 135. What's mid price? What's natural price? Well, think about this on a spread. We're selling one contract and it has a bid price and an ask price. We're buying one contract and it has a bid price and ask price. The natural price is buying at the ask and selling at the bid. That's going to give us less of a credit. We want a bigger credit though. We want as much as we can. The mid price is buying and selling mid price in between the ask and bid price for both contracts. The reality is this is probably, I can't make any guarantees, folks. We just never know. This is probably not going to get filled immediately. Okay. Maybe if the market moves a little bit after we put it in, it may fill. Okay. So there we go. The natural price is a price we probably can get filled at pretty quick, but it's a less desirable price to get filled at, right? So if this is kind of unrealistic, the mid price, and this is realistic but not desirable, then usually what you can do is you can kind of go in between these two, go in between those two. So your question, Ellie, of we never know what price it's going to fill at, but a strategy that some traders use, and it's not a recommendation of what you need to do, but just what we do in this class and in the classes that I teach is often we'll go kind of halfway between those prices. So you never know. Now, let me just do one other blip here. What about we just got filled? What price did we get filled at? You can just go to filled orders here and look. And we got filled at the 146 level, okay? 146 level. So, and by the way, you may get filled at a price that's better than what you put in, okay? If it's a limit price. You won't get filled worse if it's a limit price you put in, but you may get filled in better, okay? Hopefully that helps. Let's go back. So we did two bearish examples, and I do like to generally kind of match the examples to the market as a whole, and the market has been more bearish, admittedly. But let's take a look here on this, and I'm going to say our trend is going up. We have potential support. Was it a potential resistance right there? Okay. Potential bounce there. Potential was resistance, broke through, bounced once here. I'm going to call that a support level. So in this case, instead of doing a short call vertical, we're going to do a bullish example and do a short put vertical. I'm going to say that it's kind of gone up, maybe flagging a little bit. But keep in mind, it has done this despite the market going down, down, down. Presumably, if the market as a whole kind of settles down, then this, I'm not sure that this, I don't know what's going to happen, of course, but just because the market kind of reverses doesn't mean this is going to reverse. So this was bullish, even when the market's not doing well. This may very well continue to be bullish even if the market turns and goes bullish there. So that's the theory. That's the theory on this. Okay. So let's look at this. Our support right around that moving average, by the way, which is right around 206. Let's see what we got here on this. I'm going to go trade, and I'm going to look. Let me just get some other strike. Now you can go shorter term, longer term. I'll go 29 days. 206. We'll say 205. Put vertical, little bit, it's going to be a higher probability trade. Very often on these short verticals, we'll look for a delta, maybe in the 30 to 35 range on the short option. Here we've got a delta that's about 29, okay? So what does that mean by going a little bit below the 30? It means it's probably going to be a higher probability trade. It also means that our reward to risk isn't going to be as good, right? It's a balancing act. And the higher the probability, probably the worse the reward to risk on that, okay? So there we go. So this is what I'm going to do. I'm going to go here, and I'm going to go to this, and I'm going to sell this. And I'm going to go here, and I'm going to hold down my control key. 200, 205. Let's just look, theme of the day, let's look at that volatility here. Here's our Vega, 200, 205, were our strikes, about a 0.04. That means every point, what does that mean? What does the Vega mean? Every point of implied volatility is move is likely to affect this trade by about $4. Now, Vega isn't static, it will change over time. But that $4 difference means that if implied volatility moves some, then that may affect it. Well, let's just look here. Let me go pull up implied volatility. So if implied volatility, of course, goes up a lot, that's going to work against us. But let's say it goes down maybe to where the lower point of where we've been, down about 3 points. That'd mean about a $12 difference on the trade, which isn't necessarily make or break on the trade, but could be helpful in that regard. So, so let me do this. Let me click on that. There's our trade. So Ricebird said, is that $4 on the stock or the option? That's on the option that we're looking at here. Okay. Remember, the vertical spread we're doing is long component, short component, has two different legs. And the Vega was the difference between those two. So it'll actually positively affect one contract, negatively affect the other, but we're looking at the net here. And so that's on the contract value there. Okay. Okie dokie. So let's look at it. Confirm and send. Now, we have max profit 107. Max loss is a lot more. Well, that's the consequence of a higher probability trade. Okay, let me go back here for a sec. What are the odds on this trade? Well, from a technical standpoint, we said, look, as long as the stock stays above our short put, that's great for us. And our short put is about 205, right about where my cursor is, if you can see that. Okay, just a little bit below my support level. The break-even point is actually going to be lower than that by the amount of the credit. So if I take 205, subtract another, we'll say dollar, it's $1.07. 205, subtract another dollar, that's going to put our break-even around maybe just below the 204 level a little bit. Well, the stock right now is at 212. So if the stock's at 212, look, it can go up. That's great. Smiley face. Stock can go sideways. That's great. Smiley face. Stock can go down a little bit as long as we're above that 204 level. That's great. But it can also go way down, okay? And if it goes way down, that's your frown, okay? That's no good if it goes way down. That's why we may put an exit on this trade in case it goes down there. But keep in mind, just because our max loss point, where's our max loss at expiration? Max loss at expiration is our lower strike, 200. At expiration, that means at expiration, if the stock is at 200 or less, the theoretical max loss is going to be, well, it's the $5 difference there minus the 117. Well, that's moving, is going to be 388 or something like that. Okay, 388. That would be max loss at expiration if the stock goes below 200. However, before expiration, that's not our max loss. It's probably going to be, probably won't be, well, I shouldn't say that's not our max loss. That is our max loss, but that's not our likely scenario. If the stock were to go down to, say, 200 tomorrow or a week from now, it's unlikely we would be at a max loss scenario. You can kind of model that out, by the way, if you want, by going up here. We were looking at 200, 205. By switching this right up here to Theo Price Mark and switching this to vertical, we're going to look at that 200, 205. Here's my, let me reset this because it's reset, okay? Here's my mark, 200, 205, 110. But what if this stock goes, we'll say it takes a week, okay? So I'm going to go out a week here, push this forward time. And I'm going to say this stock goes to 200. So I'm going to say minus $12.30, puts us right at 200. Yep, I got an extra symbol in there. So that is max loss at expiration. But what is this saying the Theo price is at this point? Is it saying the Theo price is $5 at that point? No, the Theo price is $2.75 at that point. That's a long ways away. Theoretical, it's a theoretical, it's not a guarantee, folks. But that's a long ways away from a max loss on this calculator here. All right, so that's one way to kind of look at your max loss and time before expiration and whatnot. So what we may say is, look, if this starts to go south on us, how far is south? Well, I'm going to say our support was around 205. If we break below 205, I'm just going to get out of this trade. So I'm going to do kind of what we did on that first trade. I'm going to just create a first triggers sequential order. I'm going to create an opposite order. This one's going to get us out. It's going to be market, good till canceled. Click on the gear, and we're going to say if ABV marks less than or equal to 205, or you can go a little, give it a little more wiggle room there below support, say 204, and then we can click save and confirm and send. The price is moving, but confirm and send, and we're going to put this in our short vertical bucket there. Click send here. Okay, so let me just double check questions. We're right about out of time here in just a couple minutes, so let me just see if there's any questions here, and then we will wrap it up and summarize here. Thank you, Cam, for helping me out. Yeah, make sure those of you in the chat, Cam put a link to a video he did on option Greeks. That's great. Make sure you watch that. And look, what we talked about was the market. The market stinks right now, to be blunt. It's going down, down, down. So that's why we kind of targeted more bearish trades today. Who knows? You know, Mark, maybe this was the bottom and maybe the market just goes up from here. But that's why we did 2 bearish trades and 1 bullish trade example. We talked about implied volatility, how that can affect these trades, how implied volatility seems to be mellowing out just a little bit, even though the market still hasn't had much of a let up at this point. And so there we go. That was that. And we gave you some sample trades too. Examples, they're not recommendations. And remember, short options can be assigned early. Make sure you subscribe to the Trader Talks channel. Trader Talks Schwab coaching for more. And everybody have a wonderful rest of the day. Coming up next, we have getting started with stock investing. All right, so make sure you check that out. Have a great day. Bye-bye, everybody.